Asalam-o-Alikum and welcome back. So our today topic is the determination of equilibrium of Forex. So in this lecture we discuss the equilibrium condition and defining equilibrium in the foreign exchange market. We use the term equilibrium. So equilibrium in the foreign exchange market is defined as the state where the demand for a currency is equals to its supply. Hence, in this situation, there is no excess demand or excess supply, and the market is said to be in equilibrium because both are balanced. So equilibrium condition in the foreign exchange market imply a state where the foreign exchange market is balanced, and this balance of the foreign exchange market is achieved when exchange rate equals to the domestic currency divided by foreign currency. This is the basic formula to calculate the exchange rate. To ensure a balanced market where the demand equals supply, different economic condition needs to be looked at, and these conditions include inflation rate of the country and in their respective countries, interest rate of both the countries, political stability, and economic performance of both the countries. If these conditions are favorable and the demand for a currency will match its supply leading to equal. Now there are some techniques to understand the equilibrium in the foreign exchange market. So understanding equilibrium in the foreign exchange market is easier when you apply various techniques, and these methods such as using supply and demand graph and observing market dynamics can help clarify this concept. To comprehend the forces that shape the foreign exchange market, you can track the following indicator, and those indicators are included exchange rates. In this, we compare the value of the two currencies, reveal the market perception of this currency value. The second indicator include the trade balance, and in trade balance it reflects the economic health of a country affecting its currency demand. The third indicator include the economic indicator and the parameter. In this we calculate the parameters such as GDP, inflation rate, employment figures can indicate a currency perspective movement.